what's going to happen is as real-time payments are used more, we're going to move into more of a 24/7 environment. The concept of a cutoff time is going to start to edge away. Even the concept of a day end starts to become challenged. And I think we're going to see P2P use cases that are really prevalent in real-time payments start to shift to B2B. There's no good reason why you can't use real-time rails for accounts receivable flows, even FX funding. I think we could see shift in that direction. And we've got an environment that's increasingly supportive of it. I think once you have the limits that are high enough to support business, the data in terms of ISO messaging, then really you've got an environment where the real-time payments are likely to be more data rich, lower cost, faster. That'll be compelling for businesses.
Great point. John, just one random question as well. I know with Citi, obviously the global reach. Do you find it's driving adoption a little bit differently because LATAM or other Asia areas are growing faster and adopting these real-time payments faster? Is it driving for like a faster adoption rate in Canada, would you say, for Citi?
I mean, we've seen really substantial use of real-time payments in India. The UPI is huge. It's really transforming elements of that economy. In Mexico and Latin America, real-time payments is really taken off. In North America, we see interest in it really driven by use case. So if you're a digital native company trying to create a client experience that needs to exist in real time, then you need a real-time collection environment, and ultimately the treasury and liquidity management around that needs to accommodate substantial C2B collection flows, and those start to become material for digital native clients.
Great points. Absolutely. Lastly, Paul, you work for an iconic global brand, so you likely feel and understand the impact of legacy infrastructure, fractured data, end-of-day processes better than any one of us on this panel. Is Bell talking about real-time payments and its impact on liquidity management? Is this something you're really looking forward to, and how have you been preparing for real-time payments and the shift to real-time liquidity management?
Well, we've been thinking about real-time payments and other modern payment methods for a while now, because obviously there are significant changes, as the other members of the panel alluded to. I mean, from a liquidity standpoint, checks will likely disappear, and that removes float. So that's kind of a small aspect. But as we move into RTP, data becomes constant and really continuous. And so you need the payment systems to support that, and you need your internal systems to support that with, I guess, systems become more about moving data than moving funds. And to support that, you need standardization, you need automation. In a 24/7 world, you can't have any manual processes, so to speak. Everything needs to be automated. So from a practical standpoint in Treasury, what are we doing here is we're trying to understand the architecture of our systems, from our billers to our ERP, to enable us to build the building blocks to be agile and easily integrate to these new payment methods and real-time payments in particular. Secondly, we're trying to automate more, as I alluded to earlier. That means robots and system integration as much as we can. And finally, from a staffing perspective, the skill set that we think we need are those of more along the lines of project management to integrate systems, database skill sets, because of the amount of data that's going to be there. You're going to be able to need to drive reporting and insights. And finally, strong math skills, because with machine learning, which is all based on math, really, one needs to be able to not necessarily write the rocket science math that drives the algorithms, but you have to be able to interpret it. So you need the strong math background. So those are the kind of things we're thinking about in preparation for real-time payments.
Makes sense. Well, I think the future of payments is definitely here. We have over 60 countries now implemented faster payment schemes, and Canada is in the midst of creating our real-time rail. End user adoption is growing, and definitely innovative new products, new types of services are beginning to emerge. I personally define that, the toolbox of real-time liquidity management with a mix of new or emerging technologies and solutions. And off the bat, like virtual accounts, we've gone beyond simple Pobo-Kobo. The use of virtual accounts now are more like smart accounts, real accounts that store value. You can set rules for liquidity management, instant value transfer, instant consolidation, and it's used for pooling and netting. I also think of APIs, which is really the way in which systems, both old and new, speak to one another. Nothing really new, but obviously very critical as we move forward. I think about AI machine learning, and when it comes to new tech, or I would say emerging tech, which has been around, but is becoming much more sophisticated. And it can significantly help with automation that you talked about, forecasting, analytics. And then there's even blockchain, that immutable ledger. So storing records and history that can't be rewritten, enabling the instantaneous transfer of value. So, I would love to get the thoughts of everyone else on the panel. What are the new technologies and emerging solutions that you believe will have a significant impact on liquidity management? John, let's start with you.
I mean, I think, as you said, there's a technology stack for real-time treasury, and I think it consists of ISO financial messaging for sure. So ISO 20022 messages pretty broadly deployed at this point. Most of our deployments are on ISO messaging, so there's a standard there that people can use and know that it's going to work around the world with different banks. So that's well established. I think API connectivity for real-time balances, real-time payment initiation. Citi's got a library of about 84 APIs at this point, spanning account services, payment services, really trying to make sure that there's a machine interface for the scope of the services that we're offering. Instant payments, as was mentioned, if it's got rich data, it's got high limits, and ideally request for payment capability, I think, is one of the things that really lit up UPI in India and really spurred the development of an economy that's enabled by that capability. As Paul mentioned, it was interesting in the conversation we were having leading up to this, that robotic process automation is already well deployed. It was deployed at both our companies, and we discovered that just purely by happenstance. So I think certainly machine learning and robotic process operation or automation are part of that technology stack. And I think as Paul touched on, this is creating new opportunities for cash flow forecasting. So the ability to use real-time data and math to get to a better model. The last thing I guess I'd mention as part of the technology stack potentially is the application of payment throttling on one side and dynamic discounting on the other side to really enable an enterprise to balance working capital.
Yeah, I think Paul and John are onto things when they talk about robotic process automation. And Paul identified the labor issue of trying to find the right people to fit those roles that you're looking at. And John, to identify some of the technology, either hurdles or opportunities, if you will. And I think both of those things point to, are we trying to build onto the legacy systems that we already have to try and make some of these things work? Or are we actually looking at a totally different operating model to support our services? Like, are we looking at software as a service models? Are we looking at outsourcing, services that are held in the cloud, for example, so that I don't have to maintain all of those applications 24/7? There's somebody else that's doing that for me, because really I would like to have my staff be able to go to bed at night, right? So there's an opportunity there to think about, well, is the existing model going to work and going to be sufficient in the long term, or do we need to think about deploying other types of models, of operations models, platforms as a service model to get away from I'm having to do all of that and maintaining. Like the 24/7 operation means that if you are a 9-to-5 company, what do you do when you're not 9 to 5 and you've still got money movement potentially happening, especially if you're a global company or a global bank? I think that's where an opportunity for automation and maybe outsourcing is an opportunity. And then you've got the labor challenge that Paul identified earlier. Like, labor's not cheap in payments, right? And it's getting more expensive, as all of us can attest to. It's not getting cheaper. And I'm not suggesting that all of you that are out there should be asking for raises immediately, and if you're in payments, but you will know that your market value is probably higher now than it was even, let's say, 20, 30 years ago, when payments was a fairly dull space to be in, frankly. And so I think there's an opportunity there to think about, well, it's not just the technology piece that I need to worry about, it's also the labor cost that I have to think about. Am I really doing the right thing by trying to hire all these people and all this expertise into my team or into my shop, when I could be potentially looking at other ways of doing that and outsourcing, or looking at other ways of potentially taking advantage, so that I'm not having to pay all of that labor cost 100% of the time, especially if don't want to be operating 24/7. So I think there's a shift that's going to start happening. We've already seen that shift happening by fintechs that are eating at the margins of some of this business, and I think there will continue to be a shift in the bigger mainframe systems, that moving away from mainframe systems to cloud operating systems. How are you going to operate such that you have a lower total cost of operation for payments? I think that's a very interesting dynamic that's going to start playing out as people just start figuring out, hey, what does it mean to be 24/7, and what does it mean for labor and technology?
Great point. I totally agree. Paul, customers' point of view is always the most important one, and getting your angle is interesting. What are your thoughts?
Well, in terms of the fintech opportunities that are out there for corporates, I mean, I think about push to pay or request to pay, and that obviously is interesting because that can drive what I call the speed of cash, and improve our working capital and free cash flow. So that is obviously something that all corporates are going to go after. Other fintechs that are quite common are, the retail financing, and at Bell we already do that with our mobile handset. So that isn't an add-on, but it is for a lot of other industries. In the B2B space, kind of the e-transfer that's going to be coming, I think, from the fintechs is going to be really interesting and have lots of opportunities. I guess from a corporate perspective, we've kind of gone from the inflexible EDI, and now we're moving into XML ISO. And with that standardization, then you can build on top of that the APIs, either fintechs or banks, that can really help corporates. So it's kind of that evolution from EDI all the way up to APIs. And with that, hopefully we can integrate our billers, our sales systems, our payment systems, and working together, those can provide opportunities to better manage our cash flow, better manage our working capital, and drive a lot of opportunities through the data that's possessed in these systems.
And so just, I guess, digging a little bit further into that, Paul, is there specific tools or solutions that you are seeking right now, or will look for in the near future as real-time payments become more of a reality here than it is now?
Right. I mean, I think the B2B APIs are not fully out there yet, but in preparation of them arriving, what we're doing as well as building out a new treasury management system, one that's really database focused and with extreme agility and flexibility. And so we have the reporting and we have the automation that I mentioned earlier. And that's why, I was talking about no manual processes and having the right skill sets to drive that reporting. We're also using robots, as John mentioned. Specifically that helps us integrate from our TMS into our ERP system. So it's kind of a poor man's integration. Instead of having someone code a lot, you can have them do file uploads in a repeatable robot way. And that avoids all that expensive programming. But the end result is you have integration, although it's not cute. You get there. You're not getting there in style, but you are getting there in an automated way. And then finally, we're looking at machine learning again with the sophisticated math models that drives. And, we're predicting our daily receivables upward of 97% right now using models versus or using machine learning versus what we had before, which was at about 95%. So it's a slight improvement, but there are lots of opportunities to improve our forecasting across the company and across Treasury with machine learning and math, and particularly focused on fraud controls as well.
Makes sense. It's very interesting to always get everyone's thoughts on new tech or emerging tech. So I also want to touch on open banking really quickly. Open banking, as most of you are aware, it's going through, allow sharing of financial information electronically and securely with, of course, the consent of customers through open APIs. So from a fintech perspective, with access to banking APIs, open banking is going to remove third parties that are being relied on for client data, and undeniably is going to drive a lot of new solutions to market, solutions that are more tailored to customers' needs. So naturally, more solutions mean increased competition, but it'll also likely lower fees and make financial products much more accessible. So John, I'm turning it over to you a little bit. I know from my Citibank days, I can see open banking transforming multi-banking solutions that come to my mind, at least when I think about that. Product like Citi's MBTBA, or multi-banking target balancing accounts, where sweeping across various banks could be instant and flexible to consolidate the corporate's capital. From your perspective, curious to know what open banking means to you, what this means to Citi's products and services, now, especially your liquidity management solutions, since Citi is arguably the world's largest global transaction bank.
Yeah, I think, as you mentioned, Ivy, to a certain extent, elements of open banking already exist for large corporates. I think what's really changing is the technology stack that enables them. And possibly, depending on what happens through industry discussions or through regulation, the rules set around it. But I guess what I mean by that is that most large corporates are already using third-party applications to aggregate bank data today. They already use third-party applications to instruct payments today. So I think in a lot of ways, for the segment that I serve, which is big global companies, these elements of the open banking exist on a 20th century technology stack. And by that, what I mean is that it's generally an ERP system. For the most part, our clients are living in their ERP system day to day. So whether that's SAP or Oracle or Microsoft Dynamics, that's their primary interface to the bank. We have web portals, they get used, but for high cost markets like North America, it's usually direct integration. And for the most part, the difference is that's host to host today. And I think the direction that's going to take is towards more API integration. But the idea that the banks are sharing data with an application that the client has chosen to use, that's not a bank application, that's not a new concept that exists. I think what will change is the technology capabilities around it. The ability to aggregate deposits across multiple banks. A lot of clients actually want to use fewer banks rather than more banks, but the capability to use multiple banks has to be there. And most large corporates have counterparty limits that's going to keep them using multiple banks. The shifts I see really are that ISO exists as a messaging standard that makes working with different banks a lot easier. I think in terms of API integration, there's still a lot to be done in terms of some standardization there. Like I think we have PSD2 as a standard, but it's certainly not a global standard developed in the way that ISO is at this point. So you've got ERP and TMS vendors that are navigating an API environment and integrating with banks. I think the things still to be figured out, the environment that exists today, we share data. We get our clients' consent to share that data. But there's no quick and easy digital consent to be gathered to do that. We do that through conditional, traditional sort of documentation. It's digitized now, but it's still a contract that exists that enables that information sharing to go on. And it'll be interesting, I think, to see what sort of rules come in that really help different participants in the ecosystem box in their risk. I mean, if you share data, what are your obligations beyond sending that out the door? Right now, it's between bank and client, and the client is really taking responsibility for the third-party application's actions. So will that model remain or will that change? I think that's what really needs to be figured out in order to open things up further from where they are right now.
Good points. JD, want to get your perspective on open banking from IBM?
Yeah, well, you got to recognize that in other jurisdictions outside of North America, they're further ahead on this journey, right? And IBM's certainly been a part of that journey in other jurisdictions. And it's been interesting to observe as the open banking has sort of become regulated in those spaces or mandated, the number of application providers that has changed and who they are and how they're partnering with banks or other fintechs to drive services out is very interesting. I think you have to recognize the payments universe is starting to become fragmented a little bit. It's not just the traditional corporate to bank relationship or the retail consumer to bank relationship that's driving change in the industry. It's these other market players that are offering better or faster services that are sometimes getting in the middle of those relationships, sort of in between the relationship between the bank and their customer. And that leads you to think that there is a sort of a larger ecosystem developing. And so you have to recognize that as a technology provider or as a banker or as a corporate client or that's trying to serve retail clients or even as a government, that you are having to participate in a larger ecosystem. And so then you have a decision to make in terms of when it comes to real-time liquidity management. Should I really be partnering with someone? Should I be ignoring the problem and just sort of dealing with it on my own? Or is there some value in partnering with someone that's going to provide service to me specifically or service to a larger group of clients that I'm trying to attract or serve? So I think that's where it'll be very interesting to see as open banking starts to become more of a reality in Canada and the United States, where you actually see a little bit of that shift happening in the ecosystem and who the partners are in that what was the traditional ecosystem that's definitely evolved to more players. The other piece we're starting to see is the legislation is starting to catch up now, right? The Retail Payments Activities Act that was announced in the latest budget legislation for the Canadian budget, where the Bank of Canada is being expected to basically regulate payment service providers that aren't traditionally regulated. So it would be outside, it would be not the traditional players that Bank of Canada and the OSFI already regulate. This legislation would actually guide the regulation of fintechs and technology startups in that space. That's the first time we've seen that probably in North America specifically identified that way. And I'm very curious to know how that legislation, once it becomes gets signed into law, and how the associated regulations associated with that legislation actually have an impact on the ecosystem. I think what you're going to see is a rationalization of the market a little bit in terms of who's going to be able to play and keep up with that regulatory behavior. Or you might see more partnerships forming with technology providers or with banks to actually be able to meet the regulatory standards that the banks have already been subject to for a very long time. And because it's really difficult for some fintechs to really live up to the compliance mandates that banks have to live up to, and yet they share the same playing field. So it'll be very interesting to see that shift occur. I think there's going to be a shift, but it'll be interesting to see how those partnerships evolve in the ecosystem.
I definitely agree. I'm already seeing, and I think I see a lot of increased appetite for partnerships between banks and fintechs. We definitely have seen that over the last 2 years, especially. Very insightful. Okay, so let's move on to a very current topic, COVID-19. It goes without saying, managing liquidity during COVID especially is going to be challenging and critical for many businesses, as we keep hearing over and over again. The pandemics exposed gaps, especially in processes in liquidity management, which companies, of course, rely on to make decisions, especially again in times of crisis and uncertainty. Corporates and FIs have also been challenged in their ability to manage and report on their liquidity positions, as we kind of mentioned earlier, and funding capabilities. So getting that real-time cash visibility, I think, is definitely a recurring theme of what's needed, and it's heightened during times of economic crisis like now. So I think that getting the real-time visibility is really a journey rather than an overnight leap. But I do believe it's times like now that kind of push us along further into the path of real time and to digital. JD, John, what are your thoughts on COVID-19's impact and also reliance and the push on digital, new approaches for the future?
Well, yeah, I mean, I think there was a discussion of COVID-19 certainly in the opening keynote address that we had yesterday. So that topic, I think, is probably well understood by everyone here in the audience. It's definitely changed how market players are playing in the space in terms of deploying capital, where their assets are. I think there's going to be a shift, for instance, in real estate assets, and so that changes your liquidity model then too, right? Because where is your liquidity tied up? What are the assets you're using to manage your liquidity? And then then we saw the initial, reaction from central banks to insist on higher liquidity buffers, right, among FIs. Well, that's great, but then that prevents me potentially from getting involved in a digital world that's changing right now as a result of the pandemic. But now I'm having to hold higher liquidity buffers, and so I don't have the ability to spend as quickly anymore because I've got to tie up some more capital and buffers. So I think now we're starting to see that shift again. We're starting to see more investment in the digital space. So I think the acceleration that's been a sort of a reaction to the COVID-19 pandemic, I think we're going to start seeing some more changes now more rapidly than we did in the early days of the pandemic. There was the initial sort of shock and awe of the pandemic initially of what are we going to do? How are we going to manage our people and manage our systems? To, okay, now I've figured that out. I figured I can live the way I'm living now, but now I got to figure out, I've potentially lost some market traction for the last 8 months in terms of product development because I've tied up capital in other ways. So I think it'll be very interesting to see in the next few months. I think there'll probably be a lot of announcements coming out over the next several months as players are actually adopting newer models of change in the industry, and particularly when it comes to real-time liquidity management. Again, that machine learning, robotic process automation, as Paul talked about earlier. I now recognize that, somebody sitting in their home at home doesn't have to be the one that's doing all the cash flow forecasting on a spreadsheet. I can get something to do that. We've already seen that in the industry. I know that there's one petroleum producer out in Alberta that uses a robotic process automation to do all of their cash flow forecasting with all of the variables in it. And in fact, uses the price of oil as one of the parameters in there to tell them what their cash flow forecast is going to look like. And they just, anytime the price of a barrel of oil changes, they put in that parameter in their cash flow forecast, and immediately they can see what the world looks like in the next, week, month, year. So I think we're going to see more of that behavior starting to happen. And it's a question of who's going to do that and how quickly will they get involved with that, and do they need it? How quickly do they need to be involved? Because in order to facilitate real-time liquidity management, you have a whole bunch of things you got to do and get right, as Paul and John have already identified.
Great points. John, your thoughts?
I mean, I think it's clear that COVID has accelerated digitization. If you're already digitizing, you've pushed it further. If you weren't, you've really started, you've needed to take concrete steps in that direction, because it's, I think traditionally we had digitized things to make them more efficient, or we did it to make them more convenient. But I think what COVID taught us is that digitization also makes things more resilient. And it was the paper-based manual processes that were the exposure in the pandemic environment, and things that we had done to protect ourselves or be ready for a continuity of business situation really came into play. Even though some of those designs were, intended to originally be site-specific, they still worked. And the more digitized we were, the better we fared through COVID, I think is the lesson. I think COVID also exposed some supply chain frailty. So I think that resiliency lens is going to get more focus as a result of COVID. Efficiency is important, but so is resiliency. From the standpoint of the financial market, I mean, we saw certainly early gathering up of liquidity. Clients were drawing down lines, making sure that they had liquidity. Nobody was really sure what to expect quite next. And the reaction was to make sure you had your liquidity in place and secured. And then of course the stimulus response has put a lot of liquidity in the market right now. So at this point, I think to some of JD's points, I think banks are going to be hungry to lend. All of the liquidity and the stimulus needs to be deployed. So I do think that's setting us up for a strong recovery.
Paul, from a corporate angle, curious to know if COVID has impacted liquidity management for yourself, for Bell.
It didn't impact us materially. I guess we were already on our kind of speed of cash journey in terms of acceleration systems, working capital, and ISO. We're kind of a utility type company, so people or customers kept paying us without many hiccups, and self-service internet service are pretty important in the context we lived through. So didn't affect us as much as maybe other entities. Interest rates stayed lower, so for longer, so that was beneficial, I guess, from a corporate borrowing perspective. And I think generally the marketplace and corporates learned from the 2008 global financial crisis. So everyone had worked a lot more on their business continuity plans and what to do. And so I think the banks and the market and corps were kind of ready. And as John mentioned, as soon as one corporate drew on their credit lines, everyone did, and Bell included, and kind of funny because we take the money from our credit lines and we then go and deposit it at the same bank. So I don't know that it accomplished that much, but it permitted us to feel that we had the liquidity, and the whole market basically reacted well, and nothing froze. In 2008, the CP market froze for a while, and it was difficult. But this time around, it was almost business as normal. I remember we even issued long-term debts at the lowest historical rates ever for Bell in March 2020. I mean, it was right in the midst of it. So from our perspective, I guess it was an opportunity, almost a crisis not to be wasted in terms of cheap financing.
It's good to know that we have some lessons learned from the last one. So that's always good. Some very insightful and good discussions right now and perspectives. With instant or faster payments, the adoption of APIs and open banking as a catalyst, our infrastructure is slowly going to move to support real time. This is a massive shift in the world of Treasury, in the way of doing things, which is both new and exciting for some. Now, before we turn it over for a quick Q&A, I think we have about 5 minutes. Does the panelists want to share any kind of final thoughts?
I think we're getting lots of questions.
We're certainly getting a lot of questions. I mean, I think I alluded to the labor issue earlier, and I'll maybe just reiterate that in countries where we have the pig and the python demographic, where we've got this large group of retirees that have had a lot of experience in the payments market for a long period of time. I think both banks, corporates, and financial technology companies have had to figure out what's the new model of doing business, because I'm losing some intellectual capital, or can I replace that intellectual capital with a mix of operational shifts, business model shifts? And I think it'll be interesting to see how that plays out. I think many companies have already sort of figured out what their succession planning looks like, but they actually thought about their operational model having to shift, or their business models having to shift as a result of that. And so that'll be interesting to shift, especially as real-time liquidity management is not the same liquidity management that people were doing 10, 20 years ago. It's a very, very different game. And I think, so as Paul alluded to earlier, I'm going to have a different staffing needs and different intellectual capital needs than I might have relied on in the past.
One more point I'll add just on the subject of labor, because JD's brought it up, is gig economy. I think ultimately, if you see payroll move into a real-time model, that'll be material from a Treasury standpoint, and something that needs to be thought through in terms of liquidity.
I think it goes without saying, we're definitely in a massive, shift and evolution in payments and liquidity management right now. About the whole conversation today, we can really tell, and I think it requires a more tech savvy, more open-minded approach as we move forward. We're trying to rethink things now of how things are traditionally done, rather than how things are traditionally done. We need to really rethink how things could be. And I don't think it's that easy, especially from my experience working in the Fintech with different companies. It's a much difficult thing to do than easier to say than do. But we've clearly ingrained all our processes around existing legacy infrastructure. So the shift is significant for customers. Okay, any other final thoughts before? I think we're 3 minutes ahead of Q&A, but we can definitely, I know there's a bunch of questions that are coming in, so I'm happy to go try picking at them. Anything else, Paul, you want to add?
No, I think we go to the questions.
All right, let's start 3 minutes early. There's quite a bit. Let me just go through them here in no particular order. Let me see. We have, so this is a question for Paul from Japan. Sorry, I don't know if I'm mispronouncing that name. Hi, Paul, you spoke of usage of machine learning to forecast your receivables. Did you use any particular vendor solution for this? I think is one of the questions.
No, we actually built it in-house. We have a couple of math majors that helped us out. We looked at a vendor too, but the pricing seemed quite steep, and more importantly, I was scared that the knowledge after a year or two would leave the company, and then you have to start the process over, because it is really learning, and if you can do it once, then you can replicate it for different business functions after. So decided to go in-house. And the basis of it, again, is, the basic machine learning is basically 30 kind of math time series statistical models that you apply, and you see which one works best. And that's the key building block to start off of.
Well, and I think, Paul, your point there addresses one of the other questions as well that's out there in the panel, that's being posed to the panel from David Millard, who asked about challenges associated with intraday liquidity. I would, like Paul, suggesting that no one's got any historical data. And I would argue, well, actually, we do have tons of historical data. Maybe it's not all real-time payments, but we definitely have historical data in terms of our payment behaviors. And corporate payment behavior, as Paul has already identified, doesn't change that much immediately, right? And we already know from the experience with Interac about what that real-time payment lift looks like in terms of that hockey stick, of growth, which took, remember that email money transfer, or email transfer now called e-transfer, took a long time before there was a growth and traction in the marketplace. So I think with real-time payments, I don't think it's going to be a big bang. So I don't think the real-time liquidity management tool has to be there day one for the real-time payment stuff. Having said that, we already have real-time flows to a certain extent, and certainly with wires being closer to same day than they've ever been before, you do need to start looking at putting in the right tools to manage it so that you have it ready when you do start seeing the real-time payment flows pick up. I think the initial limits for real-time payments, the real-time rail, will be low enough that you won't have major shifts in liquidity happening day one. But you will see the adoption over time, just like you've seen the adoption of other rails in other countries and other jurisdictions as well, taking some time as well. So I think getting now's your chance to get your tools finally honed, as it were. And Paul's already done that with his machine learning exercise. I think now's your chance to sort of start thinking about what those tools are that you need, so that you aren't surprised. But at least you've got a burn-in time. Like, it's not going to be an overnight change in Canada, for example, with real-time rail.
I agree, and that's one of the whole points of our conversation today as well, is to with all the discussions happening about around real-time payments, we want to start considering real-time liquidity. But we've mentioned multiple times, this is not an overnight leap, right? This is going to be a slow evolution of the process, just to get everyone to start thinking along those lines. And many businesses and companies have started thinking about them, but I feel not enough in comparison regarding related to the number of current conversations and discussions happening on the payment side. So great points. I know a lot of machine learning type of questions. I think one of them was for John Davis. Sorry, can you please share any specific use cases of machine learning and RPA for real-time liquidity? Are any banks or corporates doing this?
Sure. I mean, the use case that we brought to market for machine learning is really around receivables reconciliation. So we have a capability we're offering called Smart Match, which uses machine learning. It takes in data from the payment system that we've got access to, from email, from invoices, from ERP systems, and it brings it together to produce match rates that can be trained up into the 90s to automate a lot of the manual process of determining what's this payment I'm getting for? How do I apply it against my accounts receivables? So machine learning certainly in a receivables reconciliation perspective is something we're applying. From the standpoint of robotic process automation, it's actually very much similar to the story Paul told. It's used in the context of some of our operational systems, where we've got legacy system. The next generation won't have all these screens that need to be navigated through, but at this point we can use RPA to code it and get efficiencies by having machines navigate through those processes and move our operations forward using our RPA. So it gets us greater efficiency without having to rebuild the technology that's there. It's a bridge, I think.
John, it reminds me of a comment from a legacy banker that had been, around a really long time, and he said, I want operations. If you're going to introduce digital enhancements or any kind of enhancements, I want some kind of green screen efficiency. And I think what he was addressing was his operators had become so efficient at flipping through screens that he wanted to make sure that any technology development was just as efficient or more, as a human operator could flip through a green screen. It's funny to hear that, right? Because that obviously the RPA that you're talking about, John, obviously blows. Why are we even talking about green screens at this point, right? Like, we have so far moved away from that. I think that there's the replacement of legacy systems is already real for most companies. But it's interesting to, this was only a few years ago that I heard that comment. And so there's obviously still a lot of human capital being deployed to flip through screens in certain operational areas. And there's an opportunity, especially if you're trying to manage liquidity in real time. You're not going to be able to rely on an operator to be keying in account values or payment, values or matching trades. So matching receivables is one game that, John's excelled at with Citi. It's not just receivables, it's matching trades, it's matching expected behavior against planned behavior. Have I matched all those trades, all those FX settlements, all of those market equity settlements, all of that quickly enough so that I know exactly what my position is during the day. That's going to take some effort to do, and you can't do that with human capital the same way anymore.
Absolutely. I completely agree. Okay, looking through some of the other questions here. This one is just, I guess, broadly to anybody on the panel here. Does the panel envision corporate treasurers using RPA and machine learning to do real-time investment sweeps into short-term assets?
Why not? Yeah, I mean, we look at our bank values or our liquidity position several times in the day. It's somewhat manual, I guess, now. And, why wouldn't you have a robot go in, and anything that you can think that's repetitive can be put through a robot. So, to the extent you can go get the information, and you can even drive, robots to do things from the information. For instance, we integrate our TMS bank, our Treasury account movements, and we use RPA to recognize what's coming out of the BAI files and then journalize them into SAP, which used to be a manual process, and now we do it with a robot. So you could easily optimize your liquidity with robots as well.
Great point. Question for John Davis. John, as the banker on the panel, do you see a lesser liquidity available to the banks as with RTP? Corporates may not maintain high BOD balances.
I don't know. Time will tell. At this point, we see balances coming in because this is specific investment activity going on. So we'll get chunky balances that are going to be deployed into the market. But we also have operating balances that are there to support payment flows, money in, money out. It's the day-to-day liquidity that clients need. So I think ultimately that issue of working capital is not going to go away because payments become instant, because payment terms are still not going to become instant. So I think the involvement of a bank in terms of deposit taker or balance sheet lender to support working capital, I think certainly real-time payments is going to give people the tools to pay instantly. But I think it remains to be seen whether commercial terms will be negotiated that actually make that happen more frequently.
Yeah, I think it's interesting because corporate payments or payables patterns are predicated, as John suggests, on a relationship that exists between the buyer and the supplier, and so the payment term doesn't necessarily, it just changes when you make the payment, but you're still going to need an operational balance to support that payment. And certainly in the retail space where there's more of this instant feeling of payments, we haven't seen operational balances from retail customers dry up just because now they can make those payments in real time. So I think the same experience in corporates. I don't think you're going to see those balances dry up in the account, because who's offering 5-day investment vehicles, right? That isn't in the market today. So you're still going to have money parked in a DDA waiting to be deployed, because there is no alternative other than potentially swinging it against your line back and forth, if you're trying to reduce your interest costs. So I don't think there's going to be that dramatic shift in working capital initially, not until you start seeing other vehicles that are more attractive to the corporate treasurer in terms of how to deploy their capital than having it in a DDA, especially in Canada where DDAs can earn interest, right? In other jurisdictions like the US where DDAs don't earn interest, you've already seen the shift away from leaving money sitting in your DDA that's gathering you no value. So I think in Canada, as long as you're offering interest on a DDA, you're not going to see that shift dry up, capital dry up out of the DDA account.
Okay, great. I think we're just on time. Our time's up. We have 1 minute left. I just want to take the time to thank you, everyone, for your discussions today, insights from our panel experts, and thank you, audience, for being so engaging and asking lots of great questions. So I hope everyone enjoys the rest of the conference. Thank you so much.
Thank you.
Thanks very much.
Bye.